Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be doing part 3 of our options trading course, which is a live market analysis session. Now, we do this because we don't want to always just be teaching theory and talking about trading. We want to always make sure that we take some time to reflect on what we've learned and show you how to apply it to the actual markets that you're actually trading. So today what we're going to do is we're going to do a quick review of what we learned over the past few weeks in our options education series. For those of you that maybe have missed that, we'll show you how to access those recordings so that you can go back and learn and go through the education sessions. And then what we're going to do is we're going to spend a few minutes talking about the current market conditions. We're going to talk about the Nordic markets, the major indices, what we currently see. We're also going to share with you some of our economic research as far as how the different countries are currently performing from an economics perspective, and then open this up for Q&A so that you guys can submit symbols, industries, so that we can look at some symbols together, and most importantly, show you how to take what we've learned here over the past few weeks into the context of what we're learning here today. So let's go ahead and get started, but before I do, what we're going to discuss here today is for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So the primary question that I think are on a lot of investors' minds right now is, can the Nordic markets continue to push higher? There are a lot of concerns from investors right now as far as where equity markets are currently trading versus where they think the economics and fundamentals suggest that equity markets should actually be trading at. So before I get started, how many of you on this, please bring up the chat window, which is at the bottom of your screen. And please type into the chat window, how many of you are concerned about a market pullback here because you believe that the markets are perhaps overvalued, you feel that it's a little overbought, and you're concerned about a pullback here of markets moving lower going forward? Please type yes into the chat window if you feel that you are a little concerned about that. And please type no if you're not. If you think that markets can continue to move higher, you can also type no. I want to get a good sense for the audience here in the room. So it seems like predominantly the answer to most of you is yes, but there seems to be quite a few of you that also believe that markets can continue to push higher. So we're going to show you our research, our charts, and help provide some context as far as how we're viewing the markets. And then more importantly, show you how you can leverage option strategies to play the directional views that you might have in the markets and do so in a way with limited risk. Because right now, at the end of the day, none of us know if for certain where the markets are going to go. We all have our own views. We all have our own ideas. And we want to show you how you can express your ideas in the markets. And even if you're wrong in your views, to be able to limit the amount of risk that you take in that view. So those are the things that we want to help you understand as a result of today's webinar. So my name is Tony Zhang. What I want to share with you here today are my charts, my research, and how I'm currently looking at the markets, and give you a quick review of what we learned here over the past couple of weeks. So when we started here a few weeks ago, the first topic we talked about was option Greeks. Now, option Greeks are very important to help you better understand the type of exposure that you're actually getting when you're buying or selling an options contract. Because when you buy a stock, it's really easy. You get dollar for dollar exposure. It's symmetrical exposure. If the stock goes down, if the stock goes up, you make money. If it goes down, you lose money. And the only exposure you have is to the underlying stock. If the underlying stock goes higher, you make money. If the underlying stock goes down, you lose money. You have no exposure to any other movement. You have no exposure to volatility. You have no exposure to time. The only exposure that you have is to the directional move of the stock. Now, when you're trading options, you also have exposure to the directional view of the stock. However, the exposure that you get is not direct exposure, meaning if the stock goes up by 1 crown and you own 100 shares, you're not going to make 100 crowns. If the stock goes up by 1 crown, you're going to make a fraction of that. So it's really important to understand how much exposure are you actually getting when you're trading options. And that's really where we turn to delta. Delta gives us a sense for the the change in the option price with respect to the change in the underlying stock price. So this is by far the biggest impact that you have on the directional, on the on the risk that you're taking when you're trading or when you're buying or selling an option is the underlying stock moving higher or lower has the largest impact to the P&L of your options trade. So this is by far the most important delta to the most important Greek to learn is delta. The second most important Greek is theta. Now this is something that you don't have exposure to when you're trading stocks, because when you buy a stock, it doesn't matter whether you hold on to that stock for a few minutes, a few days, a few weeks, a few years. If the stock goes up by £1, you make £1 per share. That's it. It doesn't matter how long it takes. You make the same amount of money. When you're trading options, that's not the case. If the stock moves up by £1 in a day versus £1 in a week, your P&L is going to be different. So that's why time is a second factor that you need to be considering when you're trading options. And theta tells us this is the change in the option price with respect to time. Now the value of an option, the value of the extrinsic value of the option will decay to 0 as you approach expiration. And the decay does not follow a linear line. It actually starts to accelerate as you get closer and closer to expiration. So this is the part that's, in my opinion, a little more difficult to understand, is to understand, that the fact that the value of an option that you hold will decay in value. So if you're selling the option, that works in your favor. If you're buying an option, it works against you. So time decay is a second most important factor, and largely has the second largest effect on the value of a call or a put that you hold in your portfolio. And lastly, gamma, which is the change in leverage. So in the first one, we talked about delta. Delta tells us how much exposure we get for every 1 unit of change in the underlying stock price. So if the stock price goes up by £1, how much does the option price go up by in terms of a factor of that? Now, that factor is not static, meaning if you buy a call option and the delta is 0.5, so for every £1 that the stock goes up, maybe the option moves up by 0.5. Well, guess what? Over the life cycle of the option, this 0.5 number is not static. It will actually move higher or lower. So it'll increase if the trade goes in your favor. It'll decrease if it goes against you. And it also changes with respect to time. As you get closer and closer to expiration, this becomes more sensitive. So as you get closer to expiration, the moves that you see in delta get larger. It can move anywhere from 0 to 1. And when you're far away from expiration, it'll stay fairly constant, or the movements in it are relatively small. As you get closer to expiration, the movement in delta becomes extremely sensitive. And that's really where gamma comes into play. Gamma tells you the change in delta with respect to the change in stock price. So gamma is actually what provides us with that asymmetrical risk that gives us that hockey stick, if you will, P&L chart, because everyone wants to be have unlimited rewards if they're right. So if you're correct on a call option, the further the stock goes, you make more and more money. But if you're wrong and you get the direction wrong, you actually at some point stop losing more and more money. So even if you buy, let's say a call option at 100 crowns, and even if the stock drops significantly to, let's say, 50 crowns, at some point you basically stop losing more and more money. But on the flip side, if the stock keeps going higher and higher, the higher it goes, the more money you make. This is what we call asymmetrical risk, right? So that if you're right, you can make more and more money, and there's no limit as to how much money you can make. And if you're wrong, there's only a limit as far as how much money you can lose. How does that happen? It comes down to gamma. Gamma is going to increase your delta, increase your leverage as the trade goes in your favor until it becomes 1-to-1, meaning for every 1 crown the stock moves up by, your option will move up by 1 crown. And then when it goes against you, gamma will decrease your leverage basically to 0, so that no matter what happens, even if the stock goes, from 50 to 49 to 48 to 47, you're not losing any more money. That's what's attractive about options trading, is the fact that if you're right, you have this unlimited reward, but if you're wrong, you're only risking a small amount of capital. So, but that is all comes down to gamma. So this is what we learned here over the past 4 weeks ago when we did this session here on Option Greeks. So if you're new to this concept, if you want a refresher, please follow us on YouTube. We have an OptionsPlay Nordic channel that you can follow us. We record all of our webinars there. I'll send you a link after we finish here today, or as we approach the Q&A session, so that if you miss that, you can watch that. And the second session that we did was on technical analysis, where this is really my background. I have spent almost the last 15 years as a market strategist. I started in the currency markets. And for those of you that trade currencies, you know that technical analysis is very heavily used as a form of analysis to determine the direction of a currency's pair. So what I have spent my life working on is technical strategies, understanding how technical strategies work, and more importantly, working with clients to better understand their own technical strategies and provide inputs as far as what they can do to improve their objective view of an asset class. And what I love about technical analysis is that it really provides a forecasting tool as to what is likely going to happen in the future. But the value of technical analysis really comes down to the fact that when you're trading options, there are three things that you need to know in order to decide what is the optimal option strategy. You need to know a direction. That is the case for any strategy, right? Whether you're trading stocks, futures, options, you must have a directional view first, because without that directional view, you really have no trade to make. So charting is a great tool to help you gain a directional view. Now, there are lots of other tools that can help you gain a directional view. You can look at fundamentals, you can look at statistics, you can look at news. There's lots of different ways that you can gather a directional view. However, most of the other forms of analysis do not give you a good sense for the other two factors that are very important for options traders. So you can't just have a good directional view. You also have to have a good sense for how far the stock is going to move in that direction. So for example, if a stock breaks out above, let's say this 192 level, and I think the stock's going to go higher, it's one thing to say, I think the stock's going to go higher. It's a whole nother thing to say, I think the stock is going to go, let's say 20 points higher. Now, only technical analysis typically provides you with this type of view. Depending on the asset class that you're looking at, there are some fundamentals that you can look at that provide you with a good sense for perhaps a target price. However, what those typically lack is timing. Because when you're trading options, you also have an expiration date. Not only do you need to know the direction, how far you think the stock's going to go, but you also have to have a good sense for how long it's going to take for that to happen. And that's really where technical analysis comes into play, because I can take a look at price history and I can say, well, this stock rallied from 165 to 185 in roughly 2 weeks' time, and then consolidated for a bit of time before breaking out. So it would be reasonable for this stock to move another 20, 25 points higher in, let's say, a 4-5 week time span. So that is my thesis that I can then use to see what are option strategies that I can trade to potentially profit from this thesis, so that if I'm right, I can make a profit. And if I'm wrong, I have limited risk. And that's really the tool of technical analysis. So we went over, a couple of weeks ago, all the different major forms of technical analysis. We talked about chart patterns, we talked about indicators, we talked about oscillators, we talked about moving averages, and more importantly, we talked about what each technical analysis indicator provides in terms of a view for direction, magnitude, and timing. And we talked about what are the optimal option strategies for each type of chart analysis, because they are very different. Some of them provide a clear sense for magnitude, other ones don't. And depending on whether you have a clear sense for magnitude or not, there are different option strategies that are suitable for each one. So those are the things that we reviewed here, and we provided a summary of each one of those major strategies. But at the very end, we provided some tips, which predominantly is based on my experience of doing this for the past 15 years and looking at what strategies have worked and what strategies have, what is the, I would say, key that I think differentiates what I consider successful traders versus many investors that find themselves struggling or finding themselves very frustrated with the performance of their trading. I would say that the most common theme that I see with beginners when it comes to trading is that they typically have a series of small wins that maybe bring their portfolio slightly higher, followed by one really large loss, and they kind of work their way up, and then they have big losses, and they never quite move forward with any type of large wins. And it's really just a few trades. It's never a series of losing trades. It's usually always just 2, 3 big losing trades that cause severe portfolio underperformance. If any of you can relate to that, please type 1 into the chat window of this idea of saying, you know, you have some small winners, you have some small losers, you don't really have any big you know, winners or losers, and then once in a while you have this huge loss that really blows a hole in your portfolio, right? That's a very common theme. And from my perspective, this comes down to a few different things. Number one, I tend to find that most investors that use technical analysis don't have a strong thesis as far as their trading strategy. And what that means is that the second you have 3, 4, 5 losing trades in a row, they lose confidence in that strategy and they start looking for a new strategy because they never fully truly understood their strategy fundamentally. And many times I see users, you know, make trades off of indicators. You know, indicators should only be used to provide confirmation. Your original thesis, your original idea should always come from price first, looking at just the pure price chart, not looking at indicators, not looking at moving averages, none of that stuff. You should be looking at price alone to determine direction, and then use your indicators to see if they support that view. And I always advocate use fewer indicators because most of the indicators that you use are actually achieving the same result with slightly different calculations. So most of the momentum indicators, they're all measuring the same thing. They're just measuring in a slightly different formula. So there's no need to use an RSI or a MACD and stochastics all at once. Pick one and stick to it. Successful traders stick to one strategy that they understand fundamentally and they use it day in and day out, and they don't switch indicators from one day to the next. So you really want to make sure that you stay consistent with your strategy. And more importantly, the best traders always focus all of their attention less on the strategy itself and more on risk management. And that's really where options comes into play, because you can utilize options to structure your directional view and do so in a way with limited risk. Now, can you blow a hole in your account trading options? Absolutely. However, most of the time that I see investors that kind of have these small gains and losses and then have this huge equity result, you know, huge drop in terms of equity, usually it's because they have a trade that didn't work out. And instead of just cutting their losses and moving on to the next trade, what they do is they try to get themselves back to break even. You know, maybe you have a chart setup that you really liked, right? You saw a really clean breakout and you bought a bunch of call options and you think that stock's going to break out, and it didn't break out, but you're convinced that this stock is going to keep moving higher. So you buy some more calls, and maybe the stock keeps moving lower. So you maybe buy some even more calls. It's usually that type of behavior that causes these huge losses. It's not the initial trade that usually does it. It's usually what you do after, meaning not just taking a small loss and moving on to the next trade, but feeling that you want to prove yourself right. You want to prove that your initial analysis is right. But that, ironically, unfortunately, is what usually causes most investors to blow that big hole in their account. So options is a tool to help you manage risk, but that doesn't necessarily stop you from adding a lot of options trades to one single trade and having a large loss. So those are some of the things that I tried to teach here at OptionsPlay, and we actually have some videos on this trading psychology and on how you should think about your portfolio to prevent these types of big losses in your portfolio. So those are some of the things I really encourage, and why I encourage you to follow us on YouTube, because a lot of these videos where I speak about these type of things are available there. So with that, what I want to cover with you is a broader market analysis to give you an idea as far as how I'm viewing the current markets from the Nordic's perspective, and then open this up to allow you guys to submit some symbols that we want to look at together, and we'll take a look at them. And more importantly, I'll show you how I think you should be thinking about structuring this trade using options. So I'll start off by just talking a little bit about the major market indices. So the Stockholm OMX S30, which is one that most of you are familiar with right now, ever since the March lows, you've had multiple waves higher. And now what we've managed to now is break back above that June 5th high. June 5th has been a pretty, I would say, major turning point for markets here, not just in Europe, not just in Sweden, but all over the world, June 5th. Now, the fact that the equity markets here in Stockholm has managed to break back above that level is, in my opinion, bullish. Now, we do have some negative divergence, and we saw the same thing here in US markets, where when they pushed to new highs, what we saw was that the momentum indicators did not confirm those highs. However, what we saw was subsequently was just a very small pullback before it continued to move higher. That's my base case here for Stockholm, is the fact that you have a little bit of negative divergence here, higher highs, but momentum indicators did not confirm those higher highs, which typically lead to a little bit of a short-term pullback and then a continuation higher here. Now, at this point, there's not a lot of resistance here all the way up into that 1900 area. So what you likely are going to see, at least for now, my base case is that you're going to get this slow grind higher here into that 1900 range. As if we've seen the equity markets here in the US as a bit of a template here, this tends to be a fairly slow grind with not a lot of big pullbacks here. Pullbacks typically only last 2 to 3 trading days at the longest, and that's exactly what we see in Stockholm, right? You look at these pullbacks that we've seen. None of them have lasted more than 2 to 3 trading sessions. They all tend to be very shallow. But you do get them, and those are the best opportunities to quote unquote buy the dips. So that's what we're currently seeing here in Stockholm. I would say this is the second strongest market here in the Nordics. When we look at Denmark, Denmark is by far the strongest market here in the Nordics. Denmark has managed to get back above the February 2020 highs here in this 1390 area here, about 1390 or so. And what you have is a brief pause here at that level before it simply broke out above. And that's exactly what we're seeing right now here in the NASDAQ 100 in the US, is that these markets are not really pausing at these all-time highs. They have a small pullback and they break right through and they just continue moving higher. Now, one of the things that we did point out here on this market was the fact that as markets continue to make higher highs recently, it was actually not being confirmed by momentum indicators. They're actually moving lower. So this was the negative divergence that we see, but recently that has sort of resolved itself as the markets made a higher high. Momentum indicators confirm these higher highs. Now, for those of you that are, technical analysts, many of you will say, well, this is now reached overbought, right? On the RSI, we're now above 70. The one thing I want to point out here is that markets can remain overbought for long periods of time. So just because they're overbought in itself is not a good reason to short the markets, because the markets were overbought here, it was overbought here, it was overbought here, it was overbought here, and guess what? Markets continue to move higher here. So just because you get overbought does not mean it's a good time to short the markets. Right now, from my perspective as a macro strategist, I don't see a lot of things on the horizon that generate a catalyst to move this market significantly lower. Now, I know there are a lot of investors concerned about that, because you look at economics, you look at fundamentals, and we are nowhere near the fundamentals that we had when we made those highs back in February. If you look at corporate earnings, they were substantially higher back in February 2020. If you look at economic output, substantially higher. So how can equity markets be trading even higher than, this really comes down to the monetary and fiscal stimulus that global central banks and global governments have provided to governments. You do have some inflation as a result of this printing of the money. And you also have declining liquidity. So when you have declining liquidity and smaller and investors buying into equities, you're going to see a bigger movement here to the upside. So there are a lot of explanations as far as how this is currently happening, but those are some of the trends that we're currently seeing. And our base case remains, despite the fact that things look stretched, but from a valuations perspective, from pretty much any angle you look at this, it doesn't make a lot of sense for markets to be trading this high. But despite that, we do not believe it's a good idea to short the markets or necessarily even hedge your portfolio, because hedging your portfolios, you could have hedged here, you could have hedged here, you could have hedged here, and guess what? All of those put options would have expired worthless. You would have given up almost all of these gains, if not more, from buying those puts. So it's not worth your while to buy puts right now. What you're better off doing is selling cover calls on the stocks that you own, selling credit spreads to collect premium so that you have a little bit of premium in your hand, so that when you get an acceleration to the downside, puts will be more expensive. But at that point, you're going to need those puts, versus right now, you don't know if you're going to need those puts. You're buying them unnecessarily. You're paying for time premium that you're from a probability-based perspective, you're unlikely going to actually have to leverage or use. So keep that in mind. And I know that from an investor's perspective, it's difficult to justify continuing to stay long in this market. Trust me, you're not the only one if you're concerned or you're saying to yourself, how can equity markets continue to move higher? I ask myself that same question every single day, but that's one thing versus how do you actually position yourself here in the market are two completely different things. And sometimes from a fundamental perspective and in your head, it's difficult to detach the two, but as a trader, you have to learn to detach those two things. Now, when we look at Helsinki, we see this is I would say the third strongest market, so second weakest market here in the Nordics. This has not even reclaimed its June 5th high here, so we're still trading below that June 5th high. Can we expect this to at least reach that level and potentially break higher? Potentially. But relative strength here isn't particularly strong. You do have support here on the weekly chart. Both the 20-week moving average and the 200-week moving average right now is providing some support here. So you do have, in my opinion, some support to rally into this 4250, 4300 range, somewhere in that area. But you're going to have some major resistance level there. If we can break back above that, you get into the 4600 area. But again, there's a lot of resistance here that I think this has to work through before it can get there. So this is one that I'm not as bullish on. And lastly, Oslo. We're seeing similar type trends, but Oslo even weaker. Oslo is actually still below most of these major support levels that got put in 2018 and 2019. This is the December 2018 lows. This is the mid 2019 lows. It tried to get back above it, but was rejected. So, right now we still have the 200-day moving average that it hasn't gotten above here on Oslo. Same thing. So, the 200-day moving average providing some level of resistance here. We're starting to get back above it. So, based on just the general flow of the market, my base case is that this will get its way back above the 200-day moving average, but I think it's going to be a very slow grind. So out of the Nordic markets, Stockholm, in my opinion, has a fair amount of upside here. Pure momentum. Denmark is by far the strongest of the four. If you're looking for those types of big moves to the upside, I would focus more on the Danish names, the big cap Danish names, and then some of the smaller cap and mega cap names in Sweden are the ones that I would focus my attention on when you're looking for some of these bullish setups. Now, I know there were a couple of questions here. So Jeffrey asked, what's the time scale? So with the charts that I'm sharing with you, the daily chart is always on the left-hand side. That's the daily chart. And on the left-hand side is the weekly chart. So those are whenever I share my charts, you're always going to see the weekly chart on the left and the daily chart here on the right-hand side. And Magnus asked, what is the momentum indicator you're using in the chart? Yes, this is an RSI indicator. What I have is just a standard 14-period RSI. I don't use anything fancy. And what I have is a 9-period moving average, the blue line, that smooths out the RSI. And because I do that, because the RSI is extremely volatile, it's extremely noisy. So I use the blue line to kind of smooth it out a little. It gives me a better sense for what the true direction of that RSI indicator actually is. And it filters out some of the day-to-day noise of that indicator. So I hope that answered your questions about my charts and my indicators. So let's move on. Wolfgang is saying, what date is the last bar in your charts? It's today. Today is the last bar in all of these charts. I just put together these charts about an hour or two before we started the session, so you have the latest data. So I did also want to take a look at economic data. So retail sales out of Sweden looking fairly strong here. As you can see, retail sales in terms of growth here year over year, highest since we've had since 2015. Now, a lot of it is, you know, a rebound off of the pent-up demand that we saw in terms of during, you know, granted, Sweden didn't go into full lockdown like most of the other countries, but still Sweden saw a significant dip in retail sales. We've had the significant bump here in terms of growth, in terms of retail sales. Consumer confidence, while taking a big hit during the coronavirus, so far has bounced back and leveled off. So this is one that I would really pay attention to here, is consumer confidence over the next few quarters, next few months, to see if this can continue to move higher, or if you start to see a reversal lower here, because consumer confidence has a big impact on the view of the direction of the equity markets. Equity markets are very sensitive to how consumers view the markets. So this is one that I would pay attention to because I think markets are going to react fairly strongly to changes here in the consumer confidence index for Sweden. Another one I wanted to take a look at is manufacturing. Now, the reason that we want to take a look at manufacturing is because if you think about, you know, an economy and as they bounce back, right? Manufacturing is going to be the stronger of the two sectors of the market. So we have services market and then you have manufacturing. Now, services is not going to bounce back as much as manufacturing because you have this pent-up demand with manufacturing that you simply don't have with services, because for those of you that stayed at home and didn't get a haircut, you're not going to not get haircuts for 3 months and all of a sudden go in and get 3 haircuts. You're just going to get 1 haircut when you come back. But let's say you wanted to buy a car prior to the coronavirus, you're still going to buy that same car when the coronavirus, ends, and you're going to get back to spending. So a lot of the pent-up demand for goods from a manufacturing perspective is going to catch up, but from a services perspective, you're not. So manufacturing indices are ones that we're going to likely see surprises to the upside, and that's exactly what we're seeing here in Sweden. Sweden actually, you know, the survey was about 52.1, so in expansion territory above 50. The actual came in at 53.4, so a little stronger than expected. Norway, on the other hand, came in worse than expected. The survey was 50%, came in at 46.1. So Norway back into contraction territory. And this speaks to this current bifurcation that we're seeing in those equity markets. Sweden substantially stronger than the Norwegian markets from an equities perspective, and we're seeing this reflect in the economic data. So a lot of the and this is part of why I'm not as bullish here on some of the weaker markets between Helsinki and Oslo, because the economic indicators are showing substantially weaker indicators compared to Sweden and Denmark. So those are some of the economic research that we wanted to share with you that help you, understand what's currently going on with the equity markets from an economics perspective. And lastly, what I want to do right now is I want to open this up to allow you guys to submit some symbols so that we can look at them together. Any stocks or any ETFs that you want to take a look at, feel free to type them into the chat window. The only thing I would ask is that if you're going to give us a symbol for us to take a look at together, please type in whether you're bullish or bearish on that stock, and we can look at it together, and we can take a look at, my directional view on that stock. And then what we can do is we can show you how I would structure an option strategy around that. So if you have a symbol that you want to take a look at, feel free to type it into the chat window and we'll take a look at it together. So Skanska is actually one that I was looking at here earlier today. Industrials have been doing fairly strong here, but Skanska very much range bound here. But it is, I would say there is what looks like some pretty solid support here around this 175. And if you're bullish here on Skanska, I think there's 2 ways to play this, right? So I think bullish, I would tend to agree. The question is whether you think Skanska will resume back into this low 200s or so, or do you think it's just going to stay, kind of sideways here above this 175? If you do think that it's going to move substantially higher. I think you want to look at something like a vertical spread, because the stock's currently trading at 178 crowns. Buying a call spread only costs about 710 crowns. And I would look at maybe something like a 180, 195 or 180, 190 call spread here, something along these lines. If you're looking at that 180, 190, this will only cost you 330 crowns. So this is basically playing for a breakout here back into this 195, 200 range. And you could potentially, go out to the 195s or so. As you can see, it'll cost you 390 crowns on a $178 stock. 390 divided by 178.75. You're only risking 2.1% of the entire stock's value to play for a bullish view here on Skanska. That, in this type of market environment, I think the most important thing is to limit your risk. If you can limit your risk just 2% of the stock price, then that would be a great way to play for a potential bounce here off this support level. And what I specifically like about this is that you're so close to that support level. If the stock does start to break lower, so let's say the stock starts to, starts moving below 175 and starts getting into the 160s, you should be able to cut your losses here on this spread. So let's say you pay $395. If the stock drops to, let's say, 165, let's do a little bit of math here, right? Let's say by the middle of September, this trade's not going in the direction that you expect it to, and is now trading into the 170s, let's just say 170. Here, you've lost 78%. So you've risked less than 2% of the underlying stock price. You've actually here only risked about 1.6, 1.7% of the underlying stock price. That's the type of play that I like, because if you are correct on this trade, so let's say if this stock does make it back into that 195 range or so, and let's say it does it, as you get closer to expiration, because I do think that for it to get all the way back up to 195, you give it some time. As you can see here, you're looking at about $935 of profit, about 236% return. On the flip side, if you're wrong, you'll likely get there fairly quickly. You're looking at about 300 crown loss. So you're looking at about a 900 crown trade if you're potentially correct up to that 195, and you're only risking about 300 crowns here to the downside. Those are the types of risk reward ratios that I like to play when I'm trading options. Now, if let's say you're not as bullish here, but you think that it's going to hold that 175 level, then what you can do is you can sell a credit spread. You can sell a short put vertical here. I would sell the 175, maybe 165. You're going to collect 260 crowns, which actually, in my opinion, isn't particularly attractive here. If you sold the 175, 170, you'll collect 160 on a five crown wide credit spread here. That's also a little better. And just to give you some context, right? 160 crowns on 178.75 is a little under 1% of the stock's value in 45 days. So not particularly attractive. So I think if I was playing this, I would prefer risking, as you can see, these two strategies risk roughly the same. But this one, I have a max reward of 160 crowns. Here I have a max reward of 1,100 crowns. Now, I don't quite think that you're going to get to 1,100 crowns. I think more realistic, 900, 800 crowns, that's more realistic here. But when I'm risking 300 to make 800 to 900, those are the types of risk rewards that I want to seek in this type of market environment. So that's my view on Skanska and how I would potentially play this. So Sigvar, thank you for submitting that. Someone else wanted to take a look at AstraZeneca. Let's take a look at AstraZeneca. Now, AstraZeneca is in the play for a coronavirus vaccine, but the stock has really kind of struggled here around this 950 level. 950 actually, was a level that it struggled even before the coronavirus. So just to give you some sense here, if we zoom out a little, 950 was resistance for a long time, for quite a bit of time, all the way through 2020. Now it's from providing some solid support. It's held this 960 level. So from my perspective, I'm not as bullish on AstraZeneca. And I think that this thing can continue to move sideways here for quite some time. So from my perspective, my preference would be to sell premium. So sell that put credit spread. So something like maybe a 9 I would look at maybe a 945, 915 maybe for 1,000 crowns. 945, 900 for 1,500 crowns. Any of these, in my opinion, are suitable strategies to trade, because here, as you can see, as long as AstraZeneca stays above 930, you can be profit 1,500 crowns. So 1,500 crowns divided by 965 is roughly 1.5% of the stock's value. So you'll collect 1.5% of the underlying stock's value in the next 45 days if AstraZeneca stays above 930 crowns. Actually, if it stays above 945 crowns, you'll collect 1.5%. That's not bad considering AstraZeneca pays only 2.7% for the full year in terms of dividends. Here you're collecting 1.5% in 45 days. So from my perspective, this credit spread looks fairly attractive. And as long as AstraZeneca stays above 930, those are some of the ways that you can play AstraZeneca. You know, if the only reason that I'm shying away from buying this call spread here, you know, you can, if let's say you think that there's going to be some great news on vaccine news between now and October 16th, but I'm not as strong or as certain that that's going to happen. But if you do feel that there's going to be some good news coming out of the vaccine trials here for AstraZeneca, and AstraZeneca is running, I like what they're doing here from a vaccine perspective, and they're likely going to be one of the firms that have some kind of vaccine at some point that governments are going to buy. I just don't know what that time frame looks like, and that's why I'm not willing to bet that I think it's going to happen before October. You could go out to November, but it starts to get a little bit more expensive. You can even go out to December, but again, the further you go out, the more expensive it is. But maybe some of you are willing to take that kind of risk, right? And you might want to take a low risk flyer, if you will, and hope that maybe there's something comes out between now and December 18th. Here, this costs you 4,150 crowns. And just to, again, put that into context, 4,150 crowns divided by 965, I'm risking 4.2% to play for what could be a potential big move to the upside, right? So if let's say, AstraZeneca's high here is around 1163. If AstraZeneca somehow in good news gets back up to 1163, here I'm looking at about a $10,000 crown profit off of my 4,000 crown investment or 4,000 crown risk. Those types of risk reward ratios are, in my opinion, attractive, but that's only feasible if you do see some kind of catalyst that would drive AstraZeneca substantially higher. From my perspective, only vaccine news could potentially do that. So we would have to see, and it's just a matter of whether or not that's the type of risk that you want to take. Otherwise, I would look to sell credit spreads. I think that's a better way to play this. Jeffrey's asking, I'm interested in trading options around events such as earnings. Do you have a favorite strategy for this situation? So Jeffrey, certainly I will answer that question, but let me just first take this one TEL2 question here. So TEL2, and you're bullish on it as well. So TEL2, similar to some of the other stocks in this very clear kind of channel here. So from my perspective, I would target the upper range of this channel. And if you zoom in, right, what you see here is that every single time it goes from the bottom of the channel to the top of the channel, it does it fairly quickly. It doesn't take a lot of time. It takes, it seems like the way down, it takes about a couple of weeks, and the way up about 3 weeks. The way down takes about 2 weeks, way up takes about 3 weeks. And that seems to be the fairly consistent pattern here. So if you're bullish here, maybe there are no call spreads available here. Let's see if we can find one. So if I go out to November, I can buy this 125, 137.5. Maybe 137.5 is a little too far. Maybe 135. So I can buy this 125, 135 call spread for $2.85. And this is a good example, right? TEL2 reports earnings here on October 20th. Now, this is a November 20th expiration. So this accompanies that earnings expiration. So maybe I can tackle two questions here at once. So number one, based on the technical analysis, I would be looking at strategies similar to this one here on the right-hand side. With respect to earnings, I also would look at strategies like this, because when you're trading earnings, there's only one thing that I'm most concerned about, because, from my perspective, to determine the directional view of earnings, it's kind of like flipping a coin, right? Because at the end of the day, you don't know what the earnings announcement is going to look like. And many times you could have a great earnings announcement and the stock still decline because the company provides forward guidance that is not as strong. I don't know if any of you follow Intel. Intel is a good example of this, where they recently came out with a really strong earnings report, but then they provided guidance that some of their 7-nanometer computer chips are going to be delayed by a full year. So that guidance of the delay for a full year is what drove the stock price down about 13–14% on the same day that the stock reported really strong earnings. So from my perspective, you can never predict these things with any form of accuracy, in my perspective. So the most important thing when you're trading earnings is to make sure that if you're wrong, you limit the amount of risk to as small as possible. So when you use a strategy like a vertical spread here, right? So this is risking 285 crowns on a $124 stock. So 285 divided by $124 stock, I'm only risking 2.2%. So if, let's say, for whatever reason, right, and you never know what could happen, maybe a company comes out with some terrible news that they're going bankrupt or whatever it is, right, and the stock drops substantially. Here, I'm risking only 2.2%. Even if the stock goes to zero, I'm risking 2.2%. If I'm right, I never know if I'm going to be right, but if I'm right, I can look at some pretty nice returns, right? Now, I don't know that the stock's going to pop all the way up to 137. Maybe, like I said, maybe 132 is more realistic. So if the stock reaches 132 right after earnings, so it reports earnings on October 20th, right? So let's say on October 25th, the stock is back up at 132, and we know that volatility also drops a little after earnings. That's one thing that we have to account for. As you can see here, I'm looking at about 100% return, so about a 285 crown profit on my 285 crown investment. So this is basically a 1-to-1 risk-reward ratio. So if you think that you have at least a 50% chance that the Tel2 is going to beat earnings, then this is a trade that I would make. If you say that I'm not as certain, then maybe the 1-to-1 risk-reward ratio is not the right trade to make. So this is how you should go about thinking, what strategies should you use around earnings? From my perspective, you should always try to choose strategies that have the least amount of risk. You can use strategies like this as well. You can sell a put vertical. So let's say I sold the 122.5, 117.5, collected 170 crowns on a 5-crown wide credit spread. That's not bad either. This is for if you have a more neutral view here on earnings. So if, let's say, the stock just basically stays where it is by the earnings date, here I'm looking at 170 crown profit, versus if I bought the call spread, I would be losing 109 crowns. So if you think the stock's not going to move a whole lot, then you want to sell credit spreads. If you think the stock's going to make a big move, you want to buy debit spreads. So those are the two ways that you can play this. And worst case scenario, even if the stock goes to zero, I'm only risking 330 crowns, which again is about 2.5% of the stock price. So, that's the type of maximum risk that you're taking. So whenever you're thinking about playing options around earnings, you always want to use limited risk strategies. And which one do you use depends on how far you think that stock can move on earnings. You can also look at, typically what is the average move of a stock on earnings. So you can take, I think this event here on June 15th was probably an earnings event here. Look at how far the stock moved from that last earnings event, as a result. This probably was another earnings event here. So this stock clearly moves on earnings, right? I think we see quite a few jumps here in the underlying stock price on earnings. So you can always take a look at earnings history to give you a sense for, does this stock move a whole lot on earnings? If it does, you might want to buy the debit spread. If it doesn't move at all, you might want to sell the credit spread. Okay, so that covers what I wanted to share with you here today. I really hope that you guys find this useful in helping you guys better understand how to utilize, OptionsPlay to find ideas, but more importantly, help you structure these trades and be able to analyze these trades, because it's one thing to know these strategies. It's a whole nother thing to be able to utilize them for understanding your strategies, especially if you're brand new. So the question here from Wolfgang is, can I see US stocks in OptionsPlay? You absolutely can. We have an OptionsPlay platform for US stocks, and you can access it using www.optionsplay.com for those of you that want to utilize OptionsPlay. It's not free of charge like you have for the Nordics, because the Nordics, the NASDAQ is paying for it, but you can sign up for a free version of OptionsPlay for the Nordics if you have not already done so at optionsplay.se, which I will also post into the chat window. And lastly, what I want to share with you is the YouTube channel. So if you want to go and learn more about these types of option strategies that I'm talking about, we have a whole YouTube channel with videos on this. So let me just get you the link. I highly recommend that you follow us on YouTube as well. So I just posted all links here to you guys here in the chat window. You have how to access OptionsPlay for the US, how to access the free OptionsPlay for the Nordic symbols, courtesy of the NASDAQ exchange, and also the link to our YouTube channel that you can go to view all of the education events that we have recorded. So if you missed out on the last couple of weeks, you can go there, watch those recordings. We always post them immediately afterwards so that you can watch any of these recordings, brush up on your options education, and then continue to come back and ask us questions so that you can make sure that you understand everything before you place your first trade. So thank you so much. I hope you guys have a great evening, and I'll see you guys here in a couple of weeks on our next options education event. Have a great night and good luck with trading.